Welcome everyone to this Thursday edition of Inside India. I'm Sri Jegarajah. Your headlines. We are watching global bond yields as US Treasury yields spike on concerns about President Trump's big tax and spending bill making its way through Congress. Some optimistic views on India's macro front. Morgan Stanley upgrading its economic outlook for the country, and Moody's saying the economy may be more resilient to tariffs. We'll discuss that. And will they or won't they? Reports indicating that TSMC will not be setting up a manufacturing plant in India. Let's get to Asian markets first, and the picture is one of risk aversion. That's really being driven by concern, of course, about the US fiscal position if Congress passes President Trump's proposed tax cut bill. Look at the Nikkei, a two-week low there, and we are seeing losses in the order of more than 1% for the Kospi, and relatively contained at just under 1% for the TAIEX and the Hang Seng Index. We're also keeping an eye on Treasury yields, the long end spiking past 5% on concerns about President Trump's big tax and spending bill making its way through Congress and how much that would add to Washington's growing debt load. Let's take a look at the long end. As we said, it's above 5%, 5.0891. Rate sensitive 10-year at 4.5905, and the benchmark 10-year yielding 4.5905, and at the short end, the rate sensitive 2-year at 4.0067. Let's give you Japanese JGB yields as well. Take a look at the action there. And on the 30-year side on the long end, 3.165, and the benchmark 10-year yielding 1.549. Indian government bond yields are looking like this. The benchmark 10-year yield at almost 6.2. Indian markets will be joining us in about 45 minutes' time. Here's what GIFT Nifty futures are indicating. We'll wait and see whether the Indian markets will be joining in the risk-averse mood in the broader Asian markets. In the here and now, we're looking at a 24,765 point start for the benchmark. That would represent some give back, but nothing disastrous, to the tune of about 100 points or so, given where we left off for the Nifty 50 at 24,813. Useful looking at the dollar-rupee exchange rate too while we're at it. 85.5990 is where we stand. Now, Moody's is saying tariffs may not trouble India as much. The ratings agency reiterating that India's low dependence on exports will anchor the economy. It also sees government boost on infrastructure capex, manufacturing and private consumption, helping to offset weak global demand outlook. And Morgan Stanley echoing similar sentiments for India, upgrading India's GDP growth forecasts, and MS saying domestic demand will remain the primary engine for growth for the country. The bank now sees India growing at the rate of 6.2% in the current fiscal and 6.5% in the next FY26. India's central bank has pegged the GDP growth rate at 6.5% for FY26. In a monthly bulletin released yesterday, the RBI says that the economy is showing resilience despite elevated global trade tensions. Let's get another take on India's economic outlook and bring in Sonal Verma, Chief Economist for India and Asia, ex-Japan at Nomura. She joins me here at the SGX. Sonal, welcome to Inside India. Modest upgrades by Morgan Stanley to the Indian growth forecast, but you have FY26 at 5.8%. Why so negative?
Well, I think on a relative basis, clearly India is an outperformer within Asia. But I think there are 2-3 things that we think could potentially be a headwind going forward. One is there is significant amount of export front-loading across Asia, India included, and that we think will see payback back half of this year. Second, on the urban consumption side, actually things are still, I would say, fairly weak. We have seen salary growth come down, and RBI is easing on liquidity and rates, but credit impulse is actually still moderating. And third, private investment that still remains fairly lackluster. And given the global environment we are in, we do think that will remain weak in FY26. So I think on a relative basis, we do think India is going to be an outperformer. The low inflation is a positive, more domestic demand-driven economy is a positive, but there are these headwinds which will weigh.
Let's take each of those in turn, Sonal. And India has a low ratio of exported goods to GDP. And how much then is riding on the successful conclusion of what could be historic trade deals with the European Union, with the United States? UK, India is already in the bag.
Well, a lot is riding on this. I think more from a medium-term perspective. I mean, in the next 12 months as well, this is important, particularly the India-US trade deal. If India can negotiate the reciprocal tariff rate down as low as possible and lower than some of the competitor countries, then at least in the short term, the trade diversion theme is something where India could benefit. This is something we've been seeing on the smartphone side, but potentially other sectors like textiles, etc., we could see more trade diversion in the short term. So the deal is important from that perspective. But I think the medium-term strategy of the government, of course, has been to engage with more countries on free trade agreements. The idea here really is to diversify the export base and attract more and more supply chains that are shifting from China. So it's really this medium-term strategy that is a lot more important. But of course, there's the short-term potential benefit as well.
There is a degree of execution risk and implementation risk here, but what do you think would be the net effect in terms of trade flows, increased portfolio inflows and stickier FDI commitments as a result of these trade deals seeing the light of day?
So we need to give it, I think, at least 2 to 4 years to actually pan out. I mean, near term, of course, we will see more portfolio flows because relative growth prospects look good. Macro stability is there. So there's more portfolio flows coming in on the back of that. But I think the more sticky FDI flows requires both global push and domestic pull factors. And globally, with rising bond yields and uncertainty, this tends to also defer some direct investments. But I do think as a destination in terms of the domestic pull factors plus the focus from MNCs to diversify the supply chain actually does put India in a good spot. So over the next 2 to 4 years, I think more and more FDI flows coming into what we think are low to mid-tech manufacturing sectors encompassing smartphones, but other variants of electronics, textiles, footwear, etc., should happen. So I think it's a more of a medium-term theme, and we are quite positive on India from that perspective.
Sonal, the biggest macro risk, I'm sure you'll agree, for India is the unpredictable nature of inflation, particularly food prices, given these climactic extremes that India's been witnessing. Is no stranger to that. But judging by the recent data that you've seen, does it feel like expectations on inflation are now more manageable and less problematic for the RBI than they have been in many years?
Absolutely. I think for the last 6 years, we've actually seen inflation above the RBI's 4% target. For 3 months now, we've been below the target. In fact, for this financial year, FY26, we are projecting average inflation of slightly less than 4%, and risks are skewed even lower. So we are very much likely to see inflation undershoot the target, and lots going on. I think on the food side, the supply on pulses, wheat, the favorable monsoon, the risk of China dumping, output gap being negative, manufacturing input costs being low, wages coming down. I think from all sides, it actually is pointing to a lot more benign inflation environment in the next 12 months.
And if inflation is at something of an inflection point, then where does that leave the RBI in terms of the easing bias, and how many rate cuts are appropriate for the duration of calendar 25, Sonal, and into 26?
Yeah, our view is RBI is going to be aggressive in its rate cutting cycle and probably more aggressive than what consensus is expecting. So they have already delivered 50 basis point in cuts. We think in the next 12 months we will see another 100 basis point in rate cuts. So we have the terminal rate at 5%, which with an average inflation of less than 4% still means real rates will be in the 1.5% range. So macros are still stable. Also, the fiscal space in India is limited, even with the extra dividend from the RBI that is expected. We think monetary policy is going to do the heavy lifting in India.
Sonal, you mentioned some, in the beginning of our conversation, some under-the-hood risks that perhaps many in the market are glossing over. What could go wrong? Could another outbreak of India-Pakistan hostilities derail what we have at the moment, which is economic optimism?
Well, it's not in either side's interest to prolong this. And particularly from India's perspective, there's a lot of urgent issues to deal with, starting with the US-India trade deal, getting the supply chains in, getting the growth cycle going. So that, of course, is one risk factor to watch. I think as a commodity importing country, any surge in global commodity price because of geopolitical risks would be another risk factor to watch. Too heavy rains, too little rains, vegetable prices picks up, may not be durable, but that could be a temporary issue as well. So there are risks, but I do think on net, actually, there are more positives than negatives.
Lumpiness in terms of the inflation numbers is something potentially we have to watch out for. But let's stay with the issue of defence and defence spending, which continues to rise in the Indian context. I believe it's a proposed $80 billion for 25-26 fiscal. Could this potentially throw off the focus on fiscal discipline, the plan to cut the deficits to 4.4% in fiscal 26 from 4.8%?
No, we don't think so. I think there are a couple of cushions that the government seems to be working with. One, they have actually increased the excise duty on petrol and diesel while oil prices came down. So the benefit was not passed on to consumer. So that's actually helping them get more revenues on the excise front this fiscal year. And second, as I was mentioning, the expectation is that the RBI is going to transfer more than budgeted dividend to the government tomorrow. So that's actually also going to be a fiscal positive. So, I mean, there could be additional spending on defense. There could be some shortfall in other revenues. But on net, I think the commitment to fiscal consolidation is there.
The consensus is for public capex spending to rise. What should we expect on that front? And if the aim is to ultimately crowd in private capex investment, what evidence is there that that is happening?
Well, from the government side, I think this has been a theme for the last, I would say, 4 or 5 years now already. So the central government public capex has moved up from 1.7% of GDP 5 years back to now slightly above 3% of GDP. So that big uptick in capex has already happened. I think incrementally the target is to maintain public capex at these elevated levels. But significantly moving up from here is unlikely. But given the size of nominal GDP, this still means that we will be spending substantially on public capex. So that continues. I think, there have been various reasons why private capex crowding in has not happened, including very weak demand conditions, sometimes in India, sometimes externally. But from the government side, the strategy is still to ensure A, domestic demand remains relatively stable, B, for public capex to be maintained at current levels, and C, with the supply chain shifts to see if at the margin, even if the world is becoming more protectionist, whether India's market share in global exports in some of the manufacturing sectors can be incrementally a growth driver.
So the bigger issue is, where is India's march towards advanced manufacturing? And Ashwini Vaishnaw, the IT minister, he's targeting the first domestically produced semiconductor chip by December 2025. Does that feel ambitious, or is it still achievable? And let's be frank here, we've seen very mixed fortunes and setback after setback in terms of India's ambition to attract advanced manufacturing and FDI commitments.
I think we need to start from the basics first.
Yes.
Right, and the smartphone assembly, for instance, is a starting point. Yes. Next comes manufacturing the components that go into the assembly rather than importing them. Then getting into a bigger market share on, let's say, PC, laptop making. Then moving on to making some of the, let's say, the higher nanometer. We're not immediately targeting a 5 nanometer semiconductor factory here. I think the target is to manufacture the higher nanometer, maybe more legacy versions of nanometer semiconductor manufacturing thereafter. So to my mind, this is a process.
Yes.
And India has embarked already, as we are seeing with the Apple supply chain, on getting integrated on this. And plus, not to forget the assembly and testing of semiconductor, which is an area where a number of Asian peers have done well, which is where India is also trying to get global market share. So I think the various components of electronics value chain is what we are targeting. And maybe we start off with legacy semiconductor manufacturing first, but I think the process has begun.
Does it feel, though, Sonal, that India is struggling to attract big-ticket FDI? We heard from TSMC, they don't want to make a commitment. Apple may or may not make a commitment. Tesla are talking about a cautious entry. And does the answer lie in these trade deals being pinned down and clearer market access rules?
Well, I think, some of the work we've done actually shows that India is attracting a lot of commitment. And the investment commitments that are coming in, span across different sectors. So as we were discussing, various electronics value chain, also in the auto sector, in textile and capital goods. So there are actually various sectors where we are getting more direct investment. And the interest is coming from the US, but also from various other Asian allies, Taiwan, Korea, Japan. Some companies in France and Germany are also putting in more manufacturing in India. So I think the process is ongoing. This shift is a bit different to when supply chains moved to China, where it was exclusively in China. I think now what you're seeing is people want to diversify the supply chains. So it's India plus Vietnam plus, other countries that are benefiting. Trade deals is one part of the component. I think improving the overall ease of doing business, more reforms at the state level on land, labor, more infrastructure spending, these would be extremely critical as well.
Understood. Sonal, India is rightly proud of the demographic dividend, but recent graduates are clearly struggling to find well-paying quality jobs, hence nearly 14 out of 100 youth unable to find work, according to last week's NSO data. Is enough being done by the centre to address this issue, not just by the centre and the government, but by the private sector as well?
Perhaps we need to do more. And the scale of jobs that India needs to create in the current more hostile global environment, and an environment where you have also the rise of artificial intelligence and what that does to jobs. So this is a major challenge that India needs to focus on. And I guess the solution lies in targeting various sectors. It cannot just be a manufacturing-driven job. But also looking for opportunities in the services sector, thinking about the skilling that is necessary in the educational institutions, private sector giving on-the-job skilling, government creating incentives for skilling, moving up the skill value chain depending on how the quality of jobs that get created. So definitely a major challenge and a major policy focus for the country.
And it's not just India, that's a narrative and that's a challenge that policymakers globally need to really get their arms around. Sonal, thank you very much indeed for joining me. Always a fascinating conversation with you. Sonal Vanwa there from Nomura. Right, before we head to the break, Sri Lanka's central bank cutting rates to spur growth, 25 basis point cut, came as a surprise move for the markets. The country's central bank trying to cushion the economy from potential risks arising from US tariffs. Sri Lanka had recently restructured $931 million in credit lines with India. Coming up on the programme, we will take a look at some of the global news and updates and head over to Tokyo. Trade and the tariff talk between the United States and Japan in focus. We'll be right back. Welcome back. You're watching Inside India. Some of the stories we're keeping tabs on outside of India. Israel allowed 8 trucks into Gaza carrying flour, baby food and medical supplies. However, UN officials say aid has yet to reach those in need. Israeli Prime Minister Benjamin Netanyahu says he's open to a temporary ceasefire to return hostages, but will continue military operations. Meanwhile, European countries have condemned Israeli soldiers firing warning shots near diplomats in the West Bank. Israel defended itself, saying the delegation went off route and fired to keep them away with no injuries reported. Ukraine is urging the EU to take tougher action against Russia, including seizing assets and sanctioning some buyers of Russian oil. With US President Donald Trump backing off sanctions, Kyiv wants Europe to step up and take the lead in pressuring Moscow. And the Pentagon says the US has officially accepted a luxury Boeing 747 jetliner as a gift from the Qatari government. The plane is expected to serve as the new US presidential aircraft, Air Force One. That decision has sparked outrage over ethics and national security, with critics likening it to accepting a foreign bribe and others warning of high costs and serious risks. Both Qatar and President Trump have dismissed these concerns. Pentagon saying the Department of Defense will work to ensure proper security measures are considered. Now, we mentioned the moves in the Japanese bond markets earlier. Kari Georgie joins us now from Tokyo. We're also watching for any developments in the tariff talks with the United States. So, Kari, just bring us up to speed with the progress on deal or no deal. And what are the big stumbling blocks here?
Yeah, we're heading into round 3 of these trade negotiations with Mr. Akazawa, who has been leading these trade talks, likely to be in Washington by the end of the week, according to the prime minister. And ahead of that, we did get a little bit of a taste of that, taste of what's going to come, because the U.S. Treasury Secretary Bessent met with his counterpart, Mr. Kato, of the G7 in Canada. And I think the rhetoric, when you compare it to a few weeks ago when the two gentlemen met, is that the language is a little bit more hardline from the Japanese side. I mean, they said regrettable. That was the same last time. But he's saying it's creating uncertainties, and addressing the trade imbalance with tariffs is inappropriate. So the concern is that Japan might be in it for the long game. And I point out what the Automobile Association is saying here today, because as you know, is going to be the crux of the matter. And the chairman of the auto industry just came out and said, we would ask for a swift elimination of tariffs. And I think the key here is swift, because so long as the politicians drag their feet on these negotiations, we don't really know what they're focusing in on yet. The people who are going to pay are industry, and that includes the automobile industry with these 25% tariffs, and not to mention those on steel and so forth. And you have a situation where there's no guidance for 3 of the major automakers in Japan. And even the biggies like Toyota are saying the profits are going to tank. So I think this round 3 will be critical to gauge whether or not Japan is really serious about wrapping things up ahead of the G7 summit mid-June in Canada.
Carrie, it's interesting, isn't it? And the big car makers, including Nissan, and I know they have had problems that are predating this entire tariff narrative. They're not taking any chances, are they? They are embarking on what looks to be severe cost-cutting measures. Thousands of jobs have been cut. 7 factories have been shut down by Nissan. Is that it, or is there more to come?
Well, I mean, factory closures haven't been confirmed here in Japan, but that in itself would be a huge step, right? It's really not unheard of in Japan, where the labor laws are very, very strict.
Carrie, I'm just curious, the narrative when it comes to a US-India trade deal being done is really being thwarted by agriculture. That is a highly, highly sensitive topic in India. I'm just wondering whether it's a similarly sensitive topic that is proving to be an obstacle in getting a trade deal done between the US and Japan.
Well, rice, and more rice. I mean, when it comes to Japan, man can live on rice alone. And I think this price increase that we're seeing domestically, whether or not they're going to open up the market to more U.S. rice, will be a critical component as well. I mean, the private sector is already moving to do that. But I think this is just one component. The deficit is 9 trillion yen, Sri. So you'd have to import like 9 years worth of rice to make that even.
And that's going to be nothing short of a challenge, of course, so we need a third way. Carrie, thank you very much indeed for that. Right, coming up in the programme, we will discuss India's semiconductor ambitions as the country kickstarts a 6th fab project. Ashok Chandak of IESA Semi India joins us after this short break. Welcome back. We are counting down to the market open in India, and this is how we are shaping up 15 minutes ahead of that open. GIFT Nifty futures are implying an opening number of 24,752. So that would constitute a slide, but nothing disastrous considering where we left off at the Nifty 50, 24,813 and some change yesterday. And we continue to watch what is going on with the dollar-rupee exchange rate, 85.5760. Quick check on the oil markets. This is how we stand for the two global indicators. WTI 61.57, Brent crude 64.88. India's oil imports from Russia are set to hit a 10-month high this month. That's according to ship tracking data from Kepler. Indian refiners grabbed more lighter-grade crude oil from Russia. This demand is expected to last until July and comes amid fresh sanctions on Russia by the EU and UK. Let's switch our focus back to the semiconductor story in India today. Taiwanese chipmaker TSMC reportedly refused India's invitation to set up a plant in the country. Last week, Taiwanese contract manufacturer Honhai announced a chip joint venture with HCL in India. The plant will have a capacity of 36 million chips per month. Foxconn had earlier pulled out of a semiconductor JV with Indian conglomerate Vedanta in 2023. India has been boosting its chip sector. The country launched India's Semiconductor Mission in 2021, and that aims to develop a full-stack semiconductor ecosystem and has outlaid around $10 billion for the mission. Government is supporting the sector with fiscal support, performance-linked incentives and multiple other schemes. Let's discuss this in more detail and bring in Ashok Chandak, President at IESA Semi India. He joins me now. Ashok, welcome to Inside India. First of all, any thoughts as to why TSMC said it is not setting up a plant in India?
Well, I would not comment at this moment on any rumors or informations because I do not have the concrete information what's transpiring between that. But having said that, I would say semiconductor sector being the global business, there are several players worldwide, and India is being looked into as one of the new frontier for expansion of the manufacturing ecosystem, building on to the various trends which India has, notably the design ecosystem, which is quite active and vibrant. But almost 20% of the global design pool is done by the Indian engineering pool, actually. Plus, the domestic market, which itself is growing very fast. Domestic semiconductor demand is going to grow to $103 billion as per IESA report by 2030. And also access to the global markets, semiconductor being global business. India also enjoys a good reputation and a trustworthiness in terms of the manufacturing quality and other stuff. And the last but not the least, the favorable government policies, both from the central governments as well as the state governments. So things are beginning to look up very well. So I would not get much carried away by news item about what you just mentioned on TSMC, but we look forward to much more additional opportunities and players. Those are likely to set up the manufacturing activities, particularly in India.
Yes. Thank you for that, Ashok. And it's not all bad news, is it? We mentioned just before we came to you how HCL and the Foxconn Honhai JV plant recently won cabinet approval. Clearly a step in the right direction. Is that something of a springboard or a model for future JV partnerships in advanced manufacturing and semiconductor plants?
It's indeed very important. I would call a very important milestone considering global setup of Foxconn, as a very highly integrated electronics manufacturing giant, globally number one particularly. But also we look at a couple of previous such announcements and projects. Those have already started. For example, Tata started the fab or foundry project along with PSMC from Taiwan as a technology collaborator. Micron setting up the ATMP facility. Then we have CG Power, which is India's conglomerate Murugappa Group, supported by Renesas. That's another project. Then there is a Keynes Technology. So there are a couple of such joint ventures where, or the technology transfers where the global counterparts are actively showing interest in India. But most importantly, I would call the Indian conglomerates, the corporates, are showing high degree of interest to diversify into this semiconductor field, which is considered to be the foundation technology for anything we do. So yes, HCL Foxconn is a very important milestone, but also there are other few which I just narrated, and many of you are aware, you already shown the chart. So
Yes.
this is all put together, builds multifaceted approach, and there are a few things here. Number one, the Indian conglomerates, corporates are highly interested to diversify, get into this sector. The global IDMs like Micron, they have set up, so that's another first step actually. The global companies like Foxconn, and then there is a Renesas and other stuff. And there are a few more, by the way. I mean, there are 6 projects, those are approved by central government. But in
Yes.
addition, there are at least 4 to 5 more projects, those are approved by the various state governments. There is one in called RRP in Maharashtra state. There is RIR in Odisha state. We have Polymatech and others. So it's really getting momentum, I would call.
Interesting. Ashok, I was speaking to Sonal Verma, the economist from Nomura, about India's ambition to move the economy towards more advanced manufacturing. And she made it very clear that this is a multi-year process. It's a highly complex process involved to move up a value chain of this nature. IT Minister Ashwini Vaishnaw is targeting the first domestically produced semiconductor chip in December this year, December 2025. Is that ambitious, given what we have discussed, or is it achievable? And does this require a more, perhaps, calibrated timeline?
I would say it is definitely possible because a couple of projects, particularly the Tata OSAT project in Assam, the Micron ATMP project in Sanand, that's in Gujarat, are progressing exceedingly fast. And there are some of the small projects which I already narrated, they are also progressing. So this execution is definitely key. It's very important. The fab or foundry setup is going to take several years, surely, the Tata project. It may happen another 2 to 3 years more. But the OSATs and ATMPs are going to be operational pretty soon, as good as in 6 to 9 months time frame. So it's really on track that the India-made chips would produce for a high volume. And I'm not counting the semiconductor lab, SCL, which has been operational in India for several years or decades, let's say. But that's a small volume quantity, and it's mainly used for now government programs and startups and other stuff. But these commercially high capacity projects, for example, Tata has been about 48 million units per year, and the Micron has been about 4.8 million units per year. Those should be operational in like 6 to 9 months' time.
Yes.
Obviously, the companies would comment more on them, but this is what we see outside within the industry that they are progressing pretty well.
Ashok, is the challenge the capital intensity of these projects is so great that it requires a JV partner, it requires incentives and subsidies from the centre and the backing. So are initiatives like ISM, India's flagship semiconductor mission to develop a full-track semiconductor ecosystem, are they fully fit for purpose? Are they achieving their objective?
I would call so far the objectives have been achieved, as we have seen the both global and Indian companies showing interest and progressing on the project announcement as well as the implementation and execution. However, the semiconductor ecosystem development is a long haul process. You know, many countries take it decades and decades before everything gets stabilized and you have the multi foundry scenario or multi OSAT scenarios. And that's how India is also progressing, but maybe at a faster rate. The good thing is about India's policy, which was the ISM, India Semiconductor Mission. The $10 billion was already kind of allocated for several projects. And as per our union minister and the Ministry of Electronics and IT, the second version of the policy is in making now. They are going to announce at some point of time. And that would also add up additional incentives and support that could include as the recommendations given by the industry bodies like IESA and SEMI, is to look at the gases and the chemicals and the materials and other stuff, because these are the important ingredients of the entire supply chain of making the foundries and fabs operational. So that should happen. But in addition to, I want to highlight is the several state governments, because India is a federal structure. So there is a central government, that policy, and also the states. So various states are also already ready with their semiconductor policies, and they are rolling out several incentives and supports. So be it infrastructure, the power, the availability of the water and other stuff actually, including the traditional financial fiscal benefits, like holidays and other stuff. So you have seen Gujarat, Uttar Pradesh, for example, and there is a policy in Karnataka, there is a Andhra, and there is a Tamil Nadu, Assam, all is progressing. So these are definitely helping a lot to reduce the capex burden. And it's a disability gap, because when any project has to be made new, there is always a disability gap compared to the existing players worldwide. So partially this addresses, and this is also definitely progressing.
Is there any one state or perhaps clusters of states that are emerging, Ashok? And it's interesting that you talked about the importance of dovetailing the state and the central government regulations and the approach on developing the ecosystem. Are there any of these clusters emerging that are starting to look like India's Silicon Valley?
I would call, in terms of Bangalore was long time called as the Indian Silicon Valley, mainly because of the design pool and the design talent. And almost every global player had a design center, their captive design activities in Bangalore. But looking at a manufacturing perspective now particularly, we definitely see state of Gujarat has already taken an early lead, and multiple projects are announced over there, and a lot of ecosystem buildup is happening over there, including the chemicals, the gases and minerals, what I just mentioned, materials and all those things. Plus, we also see a possibility of state of Uttar Pradesh, which is pretty close to the capital of India, Delhi, because of the lot of electronics manufacturing is happening there. The smartphones, the EMS players are also located. And that's where you see the HCL Foxconn joint venture is announced in Uttar Pradesh, close to Delhi, as they make the display driver ICs, and that's mainly consumed by the smartphones and other display devices, a lot of electronics manufacturing today. So these are the two things coming up. Assam is popping up actually, mainly because of the Tata project and some of the other stuff. So the other 2-3 states which I see, those are showing definitely a promise, in addition to other states are also showing interest. But definitely these are the 3 states I would call where, as of now, the activities have stepped up. The governments are very proactive, very forthcoming. They are also going global, meeting various global players and doing that promotions and offering all the necessary support that is needed to make such high capex and a long gestation period operational.
Ashok, where is India in terms of building the ecosystem to support the AI stack and AI developments and capacity and infrastructure? This is the 4th industrial revolution, and it doesn't come without the challenge, does it? Especially the provision of energy. And these data centers are very energy intensive. Where is India on that journey?
So there are 2 facets to it. One is the software development, because of all those AI algorithm, LLM models and other stuff. So that development is happening at multi-locations actually. There are several companies working on that. And that doesn't need a particular thing other than the access to the servers and all those things. So there is a huge amount of AI development happening in the city of Bangalore, the Hyderabad, as well as towards the Noida, Delhi side. So there are 3 areas where all these developments of algorithms is going on. And India is definitely putting a lot of emphasis and focus on developing these large language models. Those are very important from the AI perspective. But in addition, India, particularly supported by Government of India, is already setting up the data servers and the data centers, which would be having access to this development community. So there is already a program going on to set up those 10,000 units of GPUs deployment pretty soon. The RFP was already out and the deployment is in progress. And in addition, some of the companies like VVDN, they are setting up they are doing the manufacturing of the data servers. Now, installation of the data servers, obviously, it is definitely power-hungry topic. Its energy efficiency is definitely important. So there are a few states, like in the city of Mumbai, there are already a chunk of data centers, those are already installed. Considering the power availability and other stuff, including the green energy, I think the state of Odisha and also the Gujarat shows a lot of promise in terms of the availability of the green energy because of the solar energy deployment is going in a very high
Yes.
speed. So that's how it is progressing. And just to summarize, there are multiple ways India is playing onto this AI domain. One is the supported by the data center servers and the GPUs being installed for
Yes.
development purpose. Several LLM
Ashok.
models are being built, and verticals are also being targeted for applications.
Ashok, final question. You're there in Singapore. I'm sure you're having some very interesting conversations on thought leadership and human capital. Where is India on nurturing and creating the next generation of top tech talent that can play this leading role in building out India's semiconductor backbone?
I would say India is really has been putting a lot of focus on this. And if you look at the multiple topics here, except one on which I want to dwell, it's particularly on a manufacturing side, we have a major concern of the shortage of the talent and the skills because, India, the manufacturing ecosystem did not exist before. So that remains one of the key bottleneck. And there are several efforts being made by not only government, but also the industry players and also associations like ISA and SEMI to create those training activities to create this manufacturing pool of the talent, actually. So there are training programs going on by the associations, by the industries, even the equipment manufacturers. There are several equipment makers. Those are supporting the setting up of the manufacturing plants. They are training the things. And these companies, those are announced the projects. They are sending their people for training outside of India, be it Singapore or Malaysia or even in Taiwan, Japan, actually. So that's how it is progressing. For the remaining piece of talent, India is quite well ahead. There's a great leadership that exists in India because we produce millions of engineering as well as the management pools every year. And there are several, those leaders, those are already operating and managing captive design centers in India of the global companies. So that pool does
Yes.
exist. So that way, that part is already taken care. There is no problem. The startup ecosystem is ramping up. The fabless ecosystem is ramping up. There are several such programs are there, including the Government of India program called the Design Link Incentive that is now
Yes.
encouraging the startups in the fabless domain and creating the products out of India. And that remains one of the critical things for India to create the products out of India. Currently, we have been doing the only product design services as an activity, but the future is about the product creations, product development, and also the manufacturing ramp up. So that's progressing. And only manufacturing related story needs a
Yes.
lot of efforts to create the talent and the scaling activity.
Ashok, it's been a fascinating conversation. We'll leave it there, sir. Thank you very much indeed for those insights on the future of developing India's semiconductor ecosystem. Ashok Chandak there of IESA Semi India. Now, markets are open and up and running in Mumbai. We'll take a look at some of the movers after this break. We're back in 2 minutes. Indian markets have just joined the trading day, and this is what the Nifty 50 is doing. As expected, it is sharply lower, down by just under 1% at the get-go. Let's take a look at the dollar-rupee exchange rate. 85.6110 is where we are standing. Earnings parade continues in India. This is what Indigo shares are looking like. They are performing weekly, down by 1.5%. That's after the Indian airline major posted a 62% jump, despite this, in quarterly profit, and said it hopes to see a recovery in traffic in June. This after demand for some routes took a hit due to tensions between India and Pakistan. Private lender IndusInd Bank also reported quarterly earnings, seeing its biggest loss ever, net loss coming to over $261 million. The bank has been recently marred with controversy. IndusInd Bank suspects some of its employees indulged in fraud. That led to accounting lapses. That's never really helpful if you're running a banking business. It's down by 1.6%. In the meantime, earnings out from Singapore's telco giant Singtel. JP Yong has the report card and joins us now, sir.
A pretty good year, actually, for Singtel. And we did notice that net profits actually grew by more than 5 times. It's mostly because of a divestment in their partial divestment into regards to one of their headquarters that resulted in a 1.2 billion gain. But even when you strip that out, underlying profits actually grew about 9%. And there were 2 major reasons here, Sri. On one hand, they actually improved their cost structure and saw costs come down despite the fact that revenues were fairly flat year on year. But we also saw increased earnings and increased improvements, at least, from some of their major foreign associates and affiliates. Now, on one hand, we had Optus in Australia seeing return to EBITDA growth, and also the absence of some of those impairment charges that were related to some issues with regards to network outages that really plagued this telco. So it seems they're out of the woods in that sense. But keep in mind that also one of the most important foreign associates for them also is Airtel, actually. And in India, they saw the contributions to their profits from Airtel grow by a whopping 33% for that time. And because of that, Singtel is now also confident they will be able to return more capital actually to some of their shareholders. They've announced a 2 billion Singapore dollar share buyback plan that will be implemented over the next 2 to 3 years. So far, so good for Singtel, and one of the reasons why the stock is popping so far in today's session, and really underpinning of a very stable and rather encouraging year that ended in March of 2025.
What's happening with their affiliate in India, Bharti Airtel? They're cutting their footprint, they're cutting their stake in Bharti. Why are they doing that, and is there more to come? What does that tell us about Singtel's commitments to the Indian market?
Well, that is what I asked actually Ying Kwan Moon, the group CEO, earlier on today, Sri, because as we mentioned, there is strong profits, and it's one of the reasons why Singtel is doing quite well. So when times are good in India, why are you trimming your stake to raise 2 billion Singapore dollars? Well, here's what he told me as to what the rationale was behind the stake sale.
We have announced probably 2.5, 3 years ago that we would, in the medium term, we would want to equalize our stake with our Indian partner, Sunil Mittal. So we want to make sure that we actually are joined at the hip in terms of growing Airtel in India. Fundamentally, we do believe in the Indian story. The economic growth is strong, and the digitalization and the automation and drive adoption of AI is going to be a key driver to Airtel growth. In the area of focus, Airtel is now looking very strongly into enterprise businesses and the fixed businesses as well. So we believe in the long-term story of India, and we will stay invested. In the medium term, we say that we want to equalize our stake with Sunil, and therefore you see the equalization and the very small divestment of some of our stakes in Airtel.
Now, to be fair, Sri, they will still have a 28.3% stake in Airtel. And I've been covering...
They're not walking away.
They're not walking away. And when you look at the earnings of Singtel, a lot of times, on more than one occasion, whether they're profitable or not really depends on how well Airtel does as well. And they've done that for the last couple of years. So there is no reason for them to exit or to try and pare their stake significantly out of Airtel. But again, we also have to remember that this is a very, very competitive, and some have called it a cutthroat business, the telco industry in India. So how they're going to manage those competitive pressures will be an ever-present thing that they'll have to look at. So far, so good, though, with Airtel, which then translates into some of the positive profits we've seen for Singtel overall.
Yes, it sounds like they are committed to the Indian market, and this stake sale at the end of the day was de minimis. So
just to make it more, just to improve the parity that is between them and the Mittal family.
Exactly. Fantastic. JP, we'll leave it there, sir. Thank you very much indeed for joining me. Right, before we go, let's take a look at shares of NTPC Green Energy popping in trade today. This is what they're doing, up by 8.2% in a market that is down by just under 1%. So remarkable, really. The state-owned renewable energy company saw profits rising nearly threefold. That was helped by higher power sales and interest income. NTPC Green made its stock market debut last year. I'm afraid that's all the time that we have today on Inside India. Do keep watching CNBC. Access Middle East is coming up next.